So my name's Alexander Bastin. I work for a Nordic broadcasting group called MTG. If you're not familiar with it, in terms of size or in terms of number of broadcast hours, we are actually slightly bigger than SBS Discovery, roughly double the size of RTL, and our annual group revenue last year was around 1.7 billion euros. So that's roughly the size. What we do is we run free-to-air channels, we run pay TV channels, we have radio business and content production business, and what I'm working with is mainly the free-to-air part of it. So what we're going to discuss today is the free-to-air business, the AVOD services that tie into it, and how we as a premium broadcaster implemented programmatic sales on our online video inventory, and how that's going. So taking one step back, the first thing we did was to actually look at what Daniel and his team were doing. So this is research from IHS that we looked at. I think it was roughly 1.5 years ago that we looked at the previous version of this study. And we realized that we got to do something in this area. So the way we look at this, which in my experience when presenting this slide differs from some of you in the audience, is that we don't see programmatic as growing on top of the total business. We see the money in the market, that is the core of our business, converting to a programmatic ad spend. So it was clear that we needed to do something. 1.5 years ago, we started evaluating the area, started setting a programmatic strategy, and meeting with vendors. So where we are now is here. This is our tech setup as is today. So we're working with Freewheel as our main ad server. We have been doing that for quite some time. On top of that, we have the direct sales teams. They're selling the direct campaigns. We're doing the business like we always have been for the past 10 years or so. And in parallel to that, we have started working with LiveRail as our SSP offering. So LiveRail is now, I would say, a crucial part of our tech stack. But the interesting part of that is that we don't see programmatic and LiveRail as having a separate place in the value chain. We see programmatic sales and direct sales coexisting, both existing on top of the waterfall. And we also see, which I think is interesting, how the client bases, to a large extent, have an overlap. So that said, we do get some new clients. We get a better line into the digital departments at the agencies, but we also, to a large extent, see our good old clients moving from direct sales to a programmatic business model, which sort of validates my previous slide, how the money in the market is converting rather than new clients coming in to take the programmatic spend. And if you look at the bullets to the right, you'll notice that actually we don't consider it being much of a difference between a programmatic transaction and a direct transaction. We'll get deeper into that, but we aim to keep the two as close together and as similar as possible. But that's not always the case in the market, in my experience. So one of the key challenges for a publisher, in my opinion, when implementing programmatic sales is the lack of transparency in the value chain, and how we see arbitrage deals grow and being a growing industry issue. So taking the Swedish market as an example, if you look at the chart to the left, we typically in direct sales have a fixed agency commission. The deals are completely transparent. We do deals on advertiser level. The agency manages the transaction, and whatever they do on top of that, selling additional services, we don't bother with. But the transaction and the advertiser spend is completely transparent. When we move into the programmatic side of the business, more often than not, the deal looks as the chart to the right, where we, as a publisher, we have a sort of transparent transaction, but that doesn't span across the entire value chain. So there's a black box where we lack transparency, where we have intermediaries arbitraging the value chain in various steps. Worst case, you have a sales network, a trading desk, an ad exchange, one selling to the next, selling to another, each arbitraging their different steps in the chain. So the result is, of course, a discrepancy in the value chain to the far right. And for me, the question is, what is the value of that discrepancy? And who's paying for that discrepancy? Is the cost worth the value? Is it proportional to the value? And does it, at the end of the day, which is, of course, the million-dollar question, affect publisher margins, or does it cost the advertiser ad spend to be higher to get the same value? So our take on this and our setup currently, trying to stay as close to the advertisers as possible, is the following. So we have implemented what we usually call a hybrid pricing model. So we negotiate deals with the advertisers one by one, much like we have always done in direct sales, even if it's managed through a trading desk with an agency. And each advertiser gets a specific floor price. That is their negotiated rate. In the case of, well, simplified, we can break it down into 2 scenarios. So the scenario to the left, where we have supply that is greater than demand, all these clients, all these advertisers are able to buy their requested volumes at their negotiated rates, and some inventory will obviously be left unsold for MTG. Whereas on the other hand, if we have supply that is less than demand, the thing is too, the advertisers are at liberty to increase their bid rate as they want in order to buy larger volumes. And at the end of the day, we will not be able to serve the total demand that is connected to MTG. So some demand will go left unserved and will have to be spent with another publisher. So looking at the market response, I would say in general, it has been a great success. We get good and great feedback from the agencies, especially from the trading desks, and I think that is mainly due to 3 factors. So one is this is actually not my word, this is a quote from the agency. We have a record-breaking view-through rate. Thank you. So what the agencies and trading desks see is that we have a view-through rate on our ads around 95%, and the same agency claimed that usually when they buy programmatic video impressions through a sales network, they get an average of 50 down to 0% view-through rate. The second one is that we have full transparency in placements. So we are always completely transparent with where did your placement run, who watched it, and so on and so on. Everything you can ask for in the transaction. Whereas if you buy through a sales network, you might end up with a list of sites that you ran on, but you don't have visibility into the split of the placements. So where did which impression run? And the third one is that our inventory is considered being top class video inventory. So it's all click to play, it's all sound on by default, it's all a large player size, it's all brand safe, and we have literally no issues at all with ad fraud and so on. And the feedback I get is that that's still quite hard to come by looking at the programmatic ecosystem. And to give some hard facts on that, or to look at the hard facts in that area, looking at the red line, that is actually our eCPM on programmatic sales since we launched it. So we launched it with a baseline that you can see, and after we started building that business area and integrating more demand sources, the price actually has risen and fluctuated. I can't give you the exact figures, but a significant increase. So that, of course, validates that it is an appreciated product. And the next big thing that we're going to do is add some user data to the mix. We're working with a DMP called Crux, fantastic company, and what we're doing with them is we're starting to track MTG users across all of our sites. Just a brief summary is that we're using Crux to store all of that data, defining segments in 4 key groups. That is based on demographic information, based on interest, based on viewer behavior, or custom segments built together in collaboration with an advertiser or an agency. And what we're going to do is push that through our programmatic ecosystem to offer our clients the most relevant audiences for that specific campaign. So, to sum it up, I strongly believe programmatic is taking over. It's not only short-form, non-premium clips, it's definitely taking over the market as a whole. That, though, does not mean that programmatic is to be considered remnant or cheap or leftover inventory, much like you can see in the red line graph that I showed you. And looking at the pricing models, that ties into that. The RTB protocol, for example, is often bashed as being a bad pricing model, especially from the publisher perspective, where it's sort of a general consensus that you get paid less over RTB. That's not the case. You can leverage RTB, and if you set it up properly, it's just a pricing model and a protocol that provides a great deal of flexibility in your pricing. And last but not least, we strongly believe that programmatic in combination with user data is the beginning of the future of digital marketing. Thank you. Can you stick around?
Thanks a lot, Alexander, and thanks for the shout-out with the data. Is there any question in the audience for Alexander and MTG's strategy on programmatic? Up there, we see one with a microphone.
William Wadsworth, Oliver and Olbam. Thanks for a very interesting presentation. Your, I think, penultimate slide talked about the broadcaster doing a lot of the sort of data analysis and forming your own segments, albeit perhaps outsourcing some of that to Crux. Do you see any demand from agencies to get more granular insight into your own user data and for the agency to do some of their own thinking on that data and form their own view on what segments they should be buying? And if so, how do you justify you doing the data analysis rather than handing that over to the agency?
Great question. So yes, we do see demand from the agencies. They are asking for us for this continuously. That is to some extent because of their own limited data sets. So the cookie matching base is not, if the agency has a data set, it usually doesn't cover the entire cookie base that MTG has a reach to. So we can complement that data set with additional reach, making sure that you can apply your demographic targeting to the entire user base. Or we can upload offline data from an agency, might be a cookie list from an advertiser, and we can leverage that and scale that onto the MTG population. And to your point about what demand we see, currently we mainly see demand for demographic information and demographic targeting. I think that's bound to change rather soon. I mean, there was a study already 5 years ago from Nielsen claiming that that TV advertising has a 0.12 correlation with actual sales. I think many of you in this room will have heard this study. Not sure if that's valid in all cases, on all campaigns, and also on the online side, but I think it speaks to the theoretical value of interest-based or behavior-based targeting. And that I think we can contribute to a large extent there with data that is not available to the advertiser or the agency.
Is there one further question for Alexander? Yes, please.
A few rows.
Here in the front.
Hello, I'm Candice Hodams from Zaxis. I was wondering whether you were planning to take the same approach as Pangea in terms of their approach to forming a conglomerate around display, but doing the same thing with long-form video content.
Also a good question. A side note is that our project name for our entire programmatic initiative was Pangea, and then 6 months later, after meeting some vendors, all of a sudden the Pangea Alliance arose. Who knows where that came from? Anyway, we have looked into that. I think there are some good examples with, for example, Aunia in Spain with Mediaset and Atresmedia. It's very interesting, although digging a bit deeper, I'm not sure if there is a good strategic fit for MTG in our local markets doing the same. And I also think that we're to some extent moving away from that because at the end of the day, the upside is limited. If you push all your inventory programmatically, it's rather easy, and I think you would agree coming from Zaxis, buying multiple channels in a simple way. You just connect your multiple supply sources into your DSP, and you can anyway frequency cap across the various channels and the various publishers. So I actually think there's a bigger upside in doing a publisher alliance on non-programmatic sales. That said, we are definitely open to doing that with other publishers as well, but I think the main upside, if so, would rather be equalizing inventory spikes, helping each other to sort of balance the demand over the year or over a certain period of time, because I think the upside for the buy side of buying in a simpler way is limited, to be honest. Would you agree?